following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views. It's a new year and it's a whole set of new volatility discussions here in the land of Volatility Views. My name is Mark Longo from the OptionsInsider.com as well as the Options Insider Radio Network. And I am pleased to welcome you back to this whole new year of volatility discussions. We had a great 2011 on Vol Views, and we're looking forward to even more interesting discussions, even more great guests coming up here in 2012 on Volatility Views. And this program wouldn't be complete without my boon companion, the yin to my yang, the dark side to my light side. Good old Don. Good old Don Schlesinger from the Volatility Exchange. Don, welcome back and Happy New Year to you, sir.
Thank you, and to all our listeners as well. And by everything that I've been reading year end and to start the new year, every other article I read seems to be on the subject of, well, we can promise you a lot more volatility for the coming year. So I guess we can promise that markets will fluctuate. How's that for going out on a limb?
Yeah.
And I've got a theory. When everybody thinks there's going to be a ton of volatility, it's going to be a really, really, really slow year. What do you think?
We already spoke about the end of the year, how we're seeing VIX in the 20s is everybody's wagging their tongues trying to figure out what's going on. And what we said is you're returning to what normal has been for 100 years. So
exactly.
We'll see.
And that voice, listeners, is, of course, the man from the pit, a.k.a. Mr. Slinky himself. Good old Mark Sebastian from OptionPit.com joining us for this first show of the new year here on Volatility View. Happy New Year
Mark,
to
you're
you.
going to be really sad about what happened. I was out for a couple of days on vacation. I came back. Somebody had come into my office and twisted up my metal Slinky and broken it, so it's no longer a usable Slinky.
You had Slinky vandals in the Option Pit office?
I had the equivalent of keying a car done to my steel Slinky, and I'm really upset about it. And
perhaps one of your clients was less than satisfied with your gamma scalping.
Yeah, well, I've got these plastic ones from the convention, but it doesn't make the same noise.
No,
see?
plastic Slinky doesn't do it. It's got to be metal or nothing.
It's terrible, and I'm really upset about it. But no, Happy New Year, Don. I have a theory on why U.S. markets are acting the way they're acting. All right, and I want you to shoot holes in this if you can.
All right, why don't we save it for the Vol review then? We can dive into all this stuff and more in one set.
Okay, great. I can't wait for the Vol review. Don, how was your New Year, by the way?
Everything good, thanks, Mark. Happy New Year to you.
Happy New Year to you. This is my 2012 wasn't going to kick off as 2012 unless I got snuck in my Vol View show with Mark and Don. So I'm really happy to be here with you guys.
You missed it. I just described Don as the dark side to my light side, and he took some umbrage at that comparison.
So are you saying you two are like duct tape?
or the Force, whichever way you choose to view it. If you look at it as a plumbing analogy, then perhaps.
Yep. No, I'm with you.
All right.
So
I guess that would make you somewhere in the middle there. I'm not sure where that would fall.
I'd be a Wookiee.
that sounds about right. Loud, kind of boisterous, kind of crazy, a little hairy, maybe a little short for a Wookiee, but other than that, you can be an Ewok. How about an Ewok? There we go.
I'm like an Ewok. That would make sense.
I like that. Sense. All right, and with our silly comparisons in place for the new year, we're going to dive right into our volatility review.
It's time for the Volatility Review.
And welcome to the Volatility Review. This is, of course, the portion of the show where we dive in and review some of the volatility activity, the volatility action that we've seen over the past week. And actually, for us, it's been a few weeks since we had a bit of a hiatus for the holidays, so we actually haven't talked about vol for quite a while here. And it seems like we've missed quite a bit. There has been a lot going on. I think the last time we recorded, we were pontificating, and I know I was, about how vol had found a new mean somewhere in the 23 to 25 range, and boy, was I wrong. That vol is just coming off hook, line, and sinker. You can't sell it fast enough there. So, Mark, was that what you were going to say about your viewpoint for 2012? Or
well, here's kind of my thought, all right? And there's a big difference between knowing what the problem is and not knowing what the problem is. And that's part of what's causing this. And my other thought is, what they've done in Europe is clearly not enough to solve the sovereign debt situation with all those different countries. But is it enough to allow U.S. banks to decouple from their European partners and clear up a lot of that kind of systemic risk U.S. to euro, which has allowed kind of U.S. markets to start to calm down, and could be what's behind kind of the rally we're seeing in Bank of America and in J.P. Morgan and some of the other ones, and has allowed us to continue to rally in the face of the euro getting basically plastered over the last couple of days. And at the same time, now here's been actually the one thing. So that is idea number 2 on why things are going the way they are. The one thing I can't figure out, Don, is why they are plastering option vols on FXE and on the euro currency and on basically all the currencies. Would love your thoughts on my point 1, point 2, and point 3. As you are if I'm Luke Skywalker, you are the Yoda to my Luke Skywalker.
I see you've upgraded yourself in the Star Wars analogy from Ewok.
You are the Emperor to my Darth Vader.
Nothing like setting somebody up like that, and then my answer is I don't have the slightest clue for any of it. Look, on the first point, when you break down volatility and sentiment and forecasts for volatility, everybody understands that they equate it with uncertainty and simply not knowing the way things are going to go. And the whole European situation is a terribly complex one where when everything is in disarray, the uncertainty is at a maximum, and so volatility goes apace. Now you point out that, well, look, maybe one piece of this or a couple of pieces are starting to fall into place and are starting to get resolved. Are they resolved forever? Well, forever is a long time. But people perceive that there's been progress made on several fronts. And as soon as that happens, you remove just a little piece of the uncertainty that was before the resolution. So with each development comes the realization that, maybe things won't be quite as unstable as they were before. And that translates into a lowering of volatility, which is just another way of saying that there's less uncertainty on several fronts than there was before. The last point, I'm not an expert on currency, and of course I saw that once you broke through what was being bandied around as about $1.30 as the resistance level, that we quickly got down to the 127 level. And if this were an equity, I would say that people think that we have nowhere to go but, kind of up from here, and that usually translates into reduced volatility, but that's not the way it works with currencies. And currencies have a kind of a U shape to their implied volatility, such that any large movement, whether it be to the upside or the downside, produces greater volatility. And it certainly looks like there's room for more downside here. So why this rather interesting point in euro valuation and volatility seem to not be going lockstep. In other words, we've got a good deal of volatility to the downside here, and yet we're in single digits or pretty close to it in terms of realized volatility over the last month. We'll talk about the euro vol contract in a moment. So that one is a little bit strange looking for me.
I think you can make a similar argument here for VIX, perhaps pose a similar query for VIX, as we had talked about earlier for a long time, why people were keeping things at elevated levels the way they were, and now you can kind of raise the flip side of that coin. Why are people crushing it perhaps beyond the level where we thought it was appropriate? And you can make a similar query like you do for the euro now, where people had their vols out there were elevated probably for good reason for a long time, and then they started to come off, as everything did, kind of in lockstep with the equities. But yet now they've hit a point as well where you're starting to raise that same question, given all the fundamental concerns that are out there and all the still things that are still unknown, why people are still hitting this vol. And in the euro and VIX across the board, I think you can raise that same question. At least I do whenever I look at these products across the board. Like, why are we still hitting vol at these levels?
Yeah, I think you're probably right, and I think that's why the vol cones and any historical awareness of what long-term prevailing realized volatilities have been, and therefore implied volatilities going somewhat hand in hand, or at least close to them. We have had in many ways an extraordinary last year, and to assume that that's the norm is just probably not very realistic. And even though it persisted for many, many months of the past year, and I'll kind of talk about a review of what actual volatility was for the past year a little bit later on, the bottom line is that normally speaking, those kinds of levels just aren't sustainable. So when you start to revert, everybody's eyes and ears perk up a little bit, and they're kind of perplexed as to what's going on, when the answer just might be what's going on is what used to go on, for 25 years, only either you weren't around to have seen it, or maybe you forgot what things are generally like. So we'll see if Mark's forecast is correct, but I would tend to agree that it probably will not be that we're going to accept 30 and 35 and 38 volatility as the norm for the coming year.
It certainly is reverting, perhaps a wee bit quicker than a lot of people assumed. The fact
that's been the part that kind of that has surprised me. I fully expected, I was kind of thinking that we were going to see it more like a 2009 this year, where we might get one more push down and then rally. But, boy, they're pricing this stuff like, we're either going to sit here for a while, or we're heading for a nice year. What does the market typically do in election years, Mark? Any idea, or Don?
Yeah, election years are usually pretty good, and the ones previous to election years are even better, because that's when all the promises get made and then eventually not kept once somebody gets elected. But
spoken like a true cynic.
Normally speaking, they are reasonably good years for the markets, and we shall see.
That's true. Maybe they're pricing in that mid-year election bump already, and the corresponding vol decline that would come with it. I know if it's anything like 2000, that was a heck of a trading year, I know, but those are once a millennium type of events.
Yeah, right.
Well, I don't want to step all over the Euro vol review, but Mark made some interesting points, and I think you did as well, especially on the fact that, the Euro vol skew is a different beast than equity vol skew. you should have those wings being elevated, and yet the fact that they're still hitting vol across the board out in the euro kind of belies that notion, and it is a weak...
That's the part that's really messing with me, is how they can be just crushing euro vol when it's getting plastered.
Yeah, you think if anywhere there'd still be a pocket of vol and a concern right now, it would be out in the Eurozone. And
exactly. And, Mark, we're down 75 cents today. We're off in the last 3 days in the euro. We're off about, since the beginning of the week, the euro has gone from a high of about, 130.25 down to, it's moved $5 in a week, which in euro terms is a really nice move, and they're just crushing the volatility. I don't get it. Don?
Well, look, here's the thing. Last volatility settlement, which was, I guess, the December 1-month contract in the 1 vol euro was 12.84. So for the month leading to the December expiration, actual realized volatility was 12.84. And we mentioned back on the last show, as long ago as it was, that from historical levels, that was, pretty much in line, if anything, just a tiny bit high. And it may come as a surprise to both of you, but the fact of the matter is that we have an expiration today in the January 1 vol. Today is the last day. And of course, we've got a 3 vol for March going on that started in January. So it's the same partial realized volatility that's going to continue that, has been calculated. And I don't know if it'll surprise you guys, but that measured volatility over the last 20 days for the euro and last night's settlement for the January 1 vol with just a single day to go, drum roll, is 10.48. So despite what you just said, Mark, and, the numbers are what they are, it's been a week with a good deal of movement. The fact is that for the last 20 days, the actual realized volatility for the euro was 10.5. So basically, sometimes you can get, it sounds contradictory, but everybody will understand immediately. Sometimes you can get a lot of movement in a product, in an underlying, but if it's simply one-sided, sustained movement in one direction, kind of unrelenting, a little bit every day, by the calculation of volatility, that doesn't necessarily mean a lot of volatility. It may be cumulatively a lot of movement because it's all one-sided, but if it's in a fairly orderly fashion, it doesn't translate by formula into an actual volatility number that's all that high. To always that reductio ad absurdum argument, if S&P goes up 1% a day for the entire year, then it's up 252% at the end of the year. And what's the volatility? 16, 1% a day. So you had 16% volatility for the year, and the index is up 252%. So you can't lose sight of the fact as to how volatility is actually calculated when, you have the discussion as to how come they're crushing the euro, but vol is only 10.5.
It's similar to what we've seen, like I said, in other products. The other side of the argument a few months ago when things were moving in a similar direction and yet people were gobbling up vol at these, absurd levels. And now we're having the flip side of the coin where things are moving in one direction and we're seeing people hitting bids left and right on vol, And I know Mark and I, we were scratching our heads probably Q3 of last year when everyone was selling downside puts in the SPX, given the systemic shocks we were starting to see coming into the market. That seemed crazy to us. And yet we're starting to see similar activity in the euro. And you're right, Don, it is on a purely realized level, I suppose it is justifiable. All right. Well, that is an interesting debate, and I think the point is, Mark, that we are whippersnappers, and that we simply lack the breadth of Don's scope across the volatility landscape.
And by the way, I'd point out one final thing, and because we are doing the review of the past several weeks. This expiring Eurovol contract actually had a high much earlier. It's in its existence even before the calculation or realized volatility period began. It's not all that far back to when we were looking at almost 16.5 volatility. And it reached a low of 9.76 a day or two ago, bounced up a little bit on the kind of movement that Mark described, settled at 10.48 last night, and I dare say it'll probably be close to that this afternoon. But we actually had in this one contract from 16.43 down to 9.76, a greater than 40% drop in the calculated or, the actual value of the contract. So once again, we just had opportunity for a great deal of movement within a relatively short period of time that these contracts exist.
Yet another case for the fact that you can get into those contracts even on the last couple of trading days and still get a pretty decent bang for your buck, given everything we've seen time and again in the settlement of those contracts, that a few days at the end of the contract can make a serious difference in the ultimate settlement value. I would say it's surprising, but we've seen it so many times now that it's pretty much par for the course. All right, and that is going to do it for our volatility review. And now we're going to roll right into our volatility viewpoint section.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and welcome to the Volatility Viewpoint. This is, of course, the portion of the show where we sit back and sometimes we have a guest, sometimes we chat amongst ourselves here about some interesting conversation topics from the world of volatility. And since it is our first show of 2012, we're going to kick it off with a grab bag of sorts, a grab bag of volatility topics. And we're going to kick it off actually with, I think, a review of some of the key points, some of the key discussion topics that we hit on back in 2011, and now would be good to review for 2012. We know we have some new listeners joining us for the first time here in the beginning of the year, and some people may have missed a few shows here or there, so it's always good to dive back in and discuss a few concepts that we think are interesting and worthy of bringing back up again. And I know, Don, you had a few things in your grab bag, and I think we'll kick things off with a discussion we've had a few times on the show in the past, but is worth bringing up again. I think a lot of people are still confused about the way the VIX futures trade and the various nature of the relationship of the term structure of those products. And some people have some very deeply held opinions on the way that trades, and quite often they are incorrect. And we've discussed that contango here on the show in the past, but it's always worth bringing that up again and clearing the air for our listeners.
Yeah, well, I think there's just sort of like people see the way the futures trade in the front month and then the next month and perhaps the ones after, and they notice that more often than not, the farther out contracts trade at higher levels than the near term. And this is called contango in futures parlance. And I think that people just think that it's a God-given feature of volatility. That
certainly seems that way lately.
That this is the way that they should trade. And of course, we've simply mentioned that although that may have been the appearance for a good portion of the time, that there just is really no such law or no such rule, and that the levels of volatility that are currently being experienced have a great deal to say as to what predictions for future levels would be. And I think that it's so logical to me that it be that way that it almost surprises me that more people don't see this instantly. So, if you're in a regime where volatility is reasonably stable or even to the low side, it doesn't take a genius to figure out that if you're on the low end and you're predicting farther out, you're probably going to predict that levels are going to rise. Not only because volatility is mean reverting, but also because the longer you go out, the more difficult it is to make an accurate forecast, and therefore you build in a little leeway, especially for the seller who doesn't want to get caught selling volatility many months out at levels that could, potentially explode in your face. But having said all of that, and that's the argument for contango, you have to understand that this isn't always the environment. So if you've got some event, if you've got some explosion of volatility, if you've got some near-term volatility that drives levels up into the 30s, if not the 40s or higher, that we saw earlier this year when VIX hit, I think, what was 48 as a high for the year, it just isn't reasonable to then say that as we go out to the back months, we should expect to see volatility even higher still. That just doesn't make any sense. So if you're looking at 35s and 40s and 45s, the logical thing to expect is that the future and the farther out months are going to revert and come back to levels that are more sustainable and that are more normal. And in a situation like that, it shouldn't surprise anyone to see that the back months trade at lower levels than the current, and we call that backwardation. And this happens a percentage of the time as well. Now, it may happen a smaller percentage of the time than the other way around, but people need to understand that there's just no rule that says that the far out months should always be trading at higher levels than the near-term months, and that they have to take everything in context and see where we are now to be able to understand why the back months trade the way they do.
Now, we certainly see that here, just given the term structure we've seen almost locked in place for the last couple of quarters. People are starting to assume that contango is the general way of things, and that's the way all things trade, and that's the term structure that every product should have going forward on the futures options side. And that to me is always still a head scratcher. And yeah. I know, Mark, contango is one of your favorite topics, so if you want to dive in here as well, by all means.
The way I always tell people is that when there's contango, it means that people are afraid of vol going up in the long term more than they're afraid of it going up in the near term. And so expectations in the near term are that not much is going to happen, but and that's kind of it.
And I certainly agree with that.
It's completely psychological.
Yeah, and sometimes there can be some forces in the background. Basically speaking, predicting farther out volatility, just like predicting farther out weather, becomes more and more difficult the longer you go. And so in addition to that uncertainty, if there happens to be any kind of event which would be considered a potential driver of volatility that's sort of hanging out there several months down the road, for example, an election or some sort of a vote that's coming on an economic issue or what have you, that can lead to the situation that you've just described, where people simply feel that the uncertainty that's attached to the definition of volatility is just greater down the line than it is at the current moment. And the weather analogy is a very important one. If I said to you, give me a spread for the high temperature of the day for the next week, and you consult all the charts and everything, you might say somewhere between 30 and 50 degrees. And now if I say to you, give me a spread for the high temperature for next January 2013, and what's more, your financial future depends on it, you're going to come up with a hell of a wider spread than that. We could be seeing zero highs for the day a year from now. And, I'm basking in 50 degrees here in New York. Last year, we were buried under 2 feet of snow at this time.
Yeah. No, well, and let's not forget, where where's the basis of, in the end, where does the basis of every VIX calculation really come from, even in the futures? From the S&Ps, the S&P options.
That's it.
And if you look at the S&P options, the further out in time you go, the more the vol increases. And part of that is Don, another part to make up for that is that the further out in time you go, the less you get from kind of standard deviations in a lot of ways. It's kind of interesting. And so it's kind of the market's way of dealing with that. So there's a lot of good reasons for that vol to exist, but it all comes from S&P options. That is the fundamental basis of everything.
And again, it's the implied volatility of the options. And in many cases, in a calm environment, people just price in a certain amount more of uncertainty going forward, the exceptions being when you've got the very high levels near term that people understand simply aren't sustainable 6, 9, 12 months into the future. And therefore, basically provide for the opposite type of phenomenon.
Yeah, well, one interesting thing I think to think about is, and this has always been one of my small kind of, I've always wondered whether this could be part of the reason that we get vol contango in options. What is, if you're running a 30 vol with 1 day to expire, what is that standard deviation? I'll quickly tell you. 30 divided by 15.87.
You're having trouble dividing to get 2?
It's 1.89. Thank you. It's 1.89%. Now, if you go out a week, if you go out 2 days, is the standard deviation percentage more than, does it work out to double the value of a 1 day standard deviation?
No, it's a square root function.
Right, it's a square root function. So one of my theories, and it's just kind of a thing that I've been playing with, is that a little bit of this kind of vol contango has to do with, maybe the market not 100% buying into that square rooting function and, maybe tweaking. It's the market's way of tweaking that square rooting function to better represent how volatility should really how options should be priced.
Are you saying they're missing out on basic math skills?
No.
The Black-Scholes formula is a wee bit too much.
The assumption of the model is not 100% perfect.
There could be some truth to that because you look at Black-Scholes and the success of Black-Scholes is not in its precision, it's in its fungibility and fudgeability factors, and you can apply it to any scenario. So there could be a twinge of that, I suppose.
Yeah, so one of my thoughts was that a little bit of that increased implied volatility was the market's way of handling some of the some of the issues with Black-Scholes in that it's not a perfect formula.
It wouldn't be the first time we've seen some fudge factor being worked into the options market on a global
that was actually
macro scale.
Another one of my nicknames in college, fudge factor.
And we do not want to go down that road of the fudge factor nickname.
Yeah. Fudge is not a factor.
And with that horrible image in mind, we could go on about contango here for quite a while, Don. I know it's been one of our favorite topics in the past on multiple shows, but I think there is another interesting topic to bring up, and that is, of course, in fact, it's one we were just discussing, Mark and I, in the chat during this show here, is the realized vol that we saw, the actual realized vol that we saw in the market for the past year. And that's a question we hear quite a bit, and it's one, like I said, Mark and I were just bandying about to each other while we were recording the show. And I think, Don, you might have some interesting metrics to share with our listeners on that front.
Well, one of the nice applications that we have on the volex.us website for the Volatility Exchange are volatility charts of our various historical indices that we call HVOL, or historical realized volatility. So we provide 1 month, 3 month, and 1 year color-coded versions on a very wide variety and array of assets. And of course, the one that we can bring up that is of interest to a great many people would be the S&P 500 index. So the question is, if we go back to the year end, the last trading day, December 30th, and we take a look at these values, what was the actual volatility for last year, which by anybody's estimation was, this crazy, wild, volatile year where we saw VIX up in the 30s for a great part of the year. So let's start with the 1 year. 1 year volatility is very simple to explain. There's 252 trading days in a year, so you use all of them. And you plug in the 252 days into the standard deviation formula, and you calculate the volatility for the year 2011. Drum roll, answer 23.5.
Wow, 23.5.
23.5. Now, what's very interesting is it actually ended, now we're talking about 1 year volatility, where you have to use 252 data points. It actually ended on a high for a 1 year value, which is to say that if you just kind of like scroll back and take that line and look at previous 1 year rolling averages, we actually reached a low somewhere in the middle of the summer of about 14.9, and the entire 1 year average was only about 18.4. Now, I have to realize that starts with the first data point way back in January of 2011, which actually has to have then gone back another entire year and started with what would have been the entire volatility for 2010 and then work it forward. But the fact of the matter is that the final volatility number for the entire year was a little over 23. Now, look, you can interpret that two ways, and I'd like to, just to put it in context. Looking at the VIX, looking at the 30s, the 32s, the 35s, everybody saying crazy, unbelievable, remarkable volatility, 23 actually looks kind of tame compared to those numbers. When people learn what the actual market volatility was, maybe this comes as a little bit of a surprise. On the other hand, people who are students of volatility going back, forever and taking dozens, if not 50 or 75 years worth of data, the actual average volatility of the S&P is about 16% or 1% daily. So when you talk about a year in which it was 23.4 or 5, so close to 50% more, half of 16 is 8, would be 24, you're talking about a year where on average the market moved about 1.5% a day as compared to 1% a day, and that's a heck of a difference. That's a substantial difference of 50% higher volatility than what has been the historical norm over a very long time. So again, you take everything sort of in context as to, what you describe as being a volatile year. It was nowhere near the 30s that people got comfortable with the VIX, but nor was it the 16 that's been a number that has prevailed over a historically very long period of time. Just conclude by saying at the average 3-month volatility and the average 1-month volatility were both in the upper 20s. And I don't mean like 29 or 28. I mean 20.77 for the 1 month and wow. 20.43 for the 3 month. So again, levels that according to whether you're looking at historical norms or comparing it to the VIX, you come to very different conclusions as to just how volatile this particular year was.
I think that data just goes to show and to reinforce the fact that we were indeed very prescient here on the show when we predicted the true mean, the new mean of volatility was in the 23 range. So we just knew something before all the data was in. We could just sense it.
There you go.
That's part of our prognostications for the year. We're dead on in that sense. But yeah, that's true. I think that will come as surprising to a lot of our listeners, the fact that the true actual realized vol was, I think many people will say, oh, wow, only 23 and a half. I think a lot of people expected a higher number. But yeah, that's definitely, I think, going to come as a shock. And of course, some of the old school guys who do remember, the low teens days, and they weren't that long ago, probably were thinking that's crazy high. So I mean,
and what I don't know and what I should know, so I apologize for not having the statistic on hand, and maybe we'll get it for next time, and that would be to come up with similar observations for what VIX was during the year in terms of an average value, because I can only speculate here, and I'll be happy to be wrong, but having seen VIX as high as it was for such a long period of time, I'm just going to guess, and again, I'm not sure at all that I'm right, that if you took a look at what the average value of VIX was over the year, I'm guessing that risk premium that we always talk about of being in the 3-4% level under normal conditions may just have been higher last year, and that the spread on average between VIX values and actual market volatility or realized or historical volatility may have been, again, I could be wrong, higher last year than it normally is.
I wouldn't be surprised if that was the case. And I think that's your homework for next episode, Don.
That's my homework. I have to look
to
that
calculate
up.
Those numbers and come back. And we'll leave our listeners hanging with that. That'll be our tease for next week's episode. That and the true nature of Mark Sebastian's nickname of Mr. Fudge Factor. We'll leave that hanging in
not
the
Mr. Fudge Factor, just the Fudge Factor.
Just the Fudge Factor.
Remember, fudge is not a factor.
Right. And with Don's uncomfortable silence hanging in the air, we will close out the Volatility Viewpoint segment and roll right into our listener mail segment.
Listener mail. Listeners write in.
Mail's in.
Mailbox.
And it's good to open up the old mailbag again. It's been closed for quite a while. We were on hiatus for a while, and we had a number of great guests, which didn't afford us time to really dive into the mailbag. So we've been piling up some questions. I grabbed a few as we were coming into the show today. There are some more we can say for future episodes, including Don's scolding of a listener/reader in our Options Insider forums. Maybe we'll save that for another episode as well. But I think we'll kick things off with a very relevant and a very timely question from John S. in Tacoma, Washington, who sent this in via email. And he asks about the best method of volatility measurement. And we have discussed this on the show in the past, but given that this is our New Year's show, our grab bag type show, where we are reviewing topics from the past, it's worth bringing this one up again. And he asks, I've just found this show on iTunes, and I find it very enlightening. And thank you for that, John. We're glad you like the show. And he says, thank you for producing a quality program on this topic. I'm relatively new to options, and I'm looking to do some basic modeling to get a better handle on options pricing and performance. But I'm hung up on which volatility measurement to use in my model. Close-to-close volatility certainly seems the easiest, but I'm not sure if it would be accurate enough for my needs. Should I try for something intraday or stick with the easy path? Thanks, John. And so this actually leads into a perfect question for us, given our year in review type discussions today. And we've hit on this a number of times in the past. And I think the short answer depends on your accuracy needs. If this guy sounds like he's relatively basic, he's just trying to get the concepts down, then I think maybe for those purposes, if he's not actually trading off these models, I think maybe for just illumination purposes, the close-to-close would work. But of course, as he accurately assumes, the accuracy there is going to be less than if you actually incorporate the true intraday volatility. And that, of course, you're talking about an order of magnitude more work and getting those accurate numbers and being able to incorporate them in the model and having a model that updates on a real-time basis to incorporate that level of accuracy. And maybe that might be a wee bit too much work for a beginner who's just looking to get a handle on some of these concepts. But I think as you progress, and if you're using a model for actually trading or scalping or anything else you're going to be using it with, then you definitely want to increase the amount of data you're incorporating to increase your level of precision. Don, would you agree with that, sir?
Yes, I do. And I'd add one or two other things. And that is when people talk about the risk premium of implied volatility over realized, they often make the argument, as I do all the time, that this is sort of the premium that sellers are requiring or demanding of buyers because they basically are taking the open-ended risk that comes along with selling options, whereas buyers have a fixed premium that they pay, and they know going in that their risk is defined and they can never lose more than 100% of the premium that they pay. But some people advance the argument that a portion of that risk premium is due exactly to the concept that was just brought up, and that is that when you buy an option, people trade it and use it in many different ways. For the person who's going to buy a put to overlay on a portfolio and therefore offer some sort of downside protection, this is a buy and hold kind of strategy where the implied volatility that you pay, if anything, is simply going to be compared to what actual close-to-close long-term volatility is of the market to see, the relative level that was required to get in. But that's very different from a scalper. It's very different from a day trader who sits in front of his machine all day long and minute to minute watches fluctuations in price. And we all know that the intra-day volatility of any underlying market is somewhat higher, and it varies depending on how long markets are open and how they trade, but inevitably higher than close-to-close readings, such that if you're going to use options for that kind of purpose, well, then, maybe it makes sense that you pay a little bit more than close-to-close volatility, because you're trading it in a way, if anything, that's attempting to capture intraday volatility as opposed to interday or close to close. So there's one interesting point to make here. I read a paper a while ago. I'm sure these numbers change, and perhaps they're not persistent, and they may even change as to which day of the week, because they're not equal Monday through Friday. Might be interesting to pull up that paper and comment more about it. But I throw out to both of you and to our listeners what I think is kind of a fascinating statistic, and that is from tonight's close till tomorrow night's close, we get a certain amount of volatility. So the question is, what percentage of that daily movement in the price of, say, an underlying index or asset is actually due to the overnight volatility, which is tonight's close and then tomorrow morning's opening, and what percentage, the remaining from 100%, is due to the actual intraday when the market is open and trading from the opening price to the close on the next day. And I don't want to put either one of you on the spot. I can just give you the answer. But if you'd like to hazard a guess and throw out a number, how much of the daily movement close to close for, let's say, an equity asset is captured by the overnight move as opposed to the open and trading during the day move?
That's a fascinating question. I never broke it down in those specific terms before in my mind. Maybe what we'll do then with that is, Don, I like that. That'll go in the homework file. I think we'll leave that open because we are running a little bit long here. We'll leave that open for next week. We can pick up that conversation next week. We'll leave our listeners with that homework as well to mull over that topic, and it'll be a tease/homework for next week, and we can dive into what the actual percentages are, and I think that'll be an interesting jumping off point for a good conversation next week.
Sounds good.
So with that, we're going to close out our volatility mailbag. And if we didn't get a chance to get to you this week, don't worry, we'll get to you in a future show. And now we're going to roll right into our crystal ball segment.
And now we take a look at the crystal ball.
and welcome to the Crystal Ball. This is, of course, a portion of the show where we look into our crystal balls for the future and we try to divine what the market has in store for volatility. And Mr. Sebastian, we're going to kick things off with you. What does your crystal ball have in store for the market, sir?
Well, with the VIX now touching 20.5, my feeling is I think that we're going to meander a little higher from here. But if the S&Ps continue to move 0% every day, the VIX is going to drop below 20. My general feeling is that I like this is the most you'll ever hear. I like us to touch 1,300 in the S&Ps in the next week. That's my thoughts. And with that, I think the VIX is going to stick around where we are. It'll probably be unchanged on Monday. We'll see from there. So I'm a huge seller of the futures, though. The Jan future. I think the Jan future is overpriced at 23.5.
Interesting. Once again, we get into that contango argument and
Yes.
Leave that open for yet another show. Which, like I said, that's grist for the mill. We keep going back to every show because it is such fertile ground for discussion. And Mark, before you go, I believe a little birdie told me you have a volatility webinar coming up. Why don't you give our listeners a quick plug for that so they know where they can find you coming up?
On the 18th, we're doing a webinar on when not to use the VIX as an indicator. In that webinar, I'm going to briefly talk about VIX itself, and then I'm going to dig into some of its foibles that can make it a much more confusing index than a lot of people realize. It is not the simplistic. I mean, anybody who listens to this show knows because you and Don and myself do our best to educate people, but we're going to really dig into why the VIX acts the way it does on Mondays and Fridays, why it acts the way it does on down days and up days. So it should be a really enlightening webinar.
That's an interesting
You're
topic.
actually going to have an answer to when not to use the VIX as an indicator that will be other than never, huh?
Yes.
I was waiting for that one to come out, Don. I wasn't going to say it for you.
There are some great times for the VIX to be a good an indicator. You just have to be aware of what you're looking at. One of the indicator that I like best is how is the VIX actually correlating to movement in the S&Ps. And that in of itself, VIX itself, not a great indicator. VIX movement relative to S&P movement, good indicator sometimes.
I think that's a really interesting topic for a webinar. Like you said, we have discussed many of those different facets on this show and other shows in the past, but it's worthwhile putting them all together in one conversation. And I think the only problem you'll have is being able to squeeze all those discussion points into one webinar, however long it is.
We're only going to talk for about half hour, 45 minutes.
Oh, you're going to be talking pretty fast then.
Yeah, so it's going to be a very kind of generalistic discussion. I'm going to pick one specific thing to talk about, and then we'll move on from there. So on that note, guys, go to optionpit.com. I have to run.
Okay, thank you for that, Mr. Sebastian. And now, of course, in the Crystal Ball segment, we also discuss and prognosticate on the future of euro volatility, specifically in the euro vol contract. And Don, I imagine you have some interesting guesswork or some interesting analysis to do on that front.
Well, we're at that point that we were speaking about a little bit earlier, where basically you've got this historical level that's pretty much in line with long-term averages, and yet we do have that overriding feature that seems to be that as you go out farther, we get this contango, and as you look at the February forecast, we're already looking at options implieds in the 13s. We're looking at the Volatility Institute forecast of about 11.5. And if you go out to 3-month values all the way out to June, we're looking at mid 14. So this is persistent and it's overriding. I tend to fade numbers like that. So I basically like to say that all things being equal, the options implied more often than not overstate what actual realized volatility goes on to display. So if you see these contracts starting to trade before the calculation period at these 13 and 14 levels, I'd step up and say that they're more likely to be lower when the actual values are calculated.
That gets into another one of our favorite topics here on the show is, of course, that implied versus realized premium and when to fade it. And if you did fade it aggressively over the past year, you probably did all right, given the what we saw, particularly on those Euro vol contracts, particularly when you first listed them. If you remember those levels that
Absolutely.
people were predicting, they were astronomical compared to the realized. I think if anyone wants a great primer on the implied premium to realize, go back and look at those first few trading weeks of the Euro vol contract and see what people were predicting for a realized vol based on the implied levels, and see how precipitously it came in over those first few weeks. And if you faded it aggressively then, you did fairly well. You could have gone home for the rest of the year, I think.
You're absolutely right, and you have a good memory. People might remember we actually first listed the contract back in February of last year, so we're close to the 1-year anniversary of listing the first product, even as we get ready to bring out some equity products in the very near future. But you're absolutely right, and that was a feature in the early going.
How could I forget, Don? That was back when you and I were sitting by the croquet courts there in sunny Boca and discussing the realized versus implied premium and how it was a perfect scenario and a perfect setting to do that in. Maybe we'll have to do it again this year.
That day, huh? That was one of the highlights.
That was a great day to be doing the show. It just seemed a perfect setting to be discussing volatility in that pristine resort next to the croquet courts. It was perfect.
Absolutely.
And the palm trees, of course. All right, and that is going to do it for this episode of Volatility Views. And before we go, Don, I know you like to give our listeners an update on what's going on over at volex.us. When we last talked, you were just in the process of implementing the Bloomberg functionality and with the vol contract. So A, give our listeners an update on that, and then B, if you have any other updates that are interesting you might want to throw in there, go ahead.
We now are fully functional on Bloomberg. We have a number of pages up, and you simply type in Volex, and hit your go button, and you'll see the entire suite of products in terms of the actual Volex indices and series that we have talked about many times on the program. I would like to end by bringing up one final application for everybody to look at on the website. It's a really fascinating one, and it's our multi-asset application. So if you go into the data section of the menu and you pull up the Volex indices, you can pull up any chart type. Let's say you pull up the S&P by clicking on its little chart in the proper section. And you come to the chart type selection. If you choose multi-asset comparisons in the top, what you get is the particular asset that you began with, and then you're able to compare it to a wide array of other assets down the column, a couple of dozen actually. So you get a wonderful chart that shows you historical volatility of multi-assets for comparison. You can drag the mouse and see the actual values throughout the year or 2-year, whatever period you chose. So it's a fascinating application for visually comparing historical volatilities of 2, 3, as many assets as you click on, seeing how they may move in harmony or opposite from one another. So check out that particular application. It's really quite interesting.
You guys are always coming up with interesting and unique new ways to play with and analyze and estimate volatility over there on volex.us. So I encourage all of our listeners to surf on over there and check that out, as well as the vol cones and all of the interesting papers you have in there. And there's quite a few things you can do over on the volex.us website if you have a few minutes to spare. Before we go, Don, really quick, are there any teases you can leave our listeners with regarding, I know you've hinted in the past about some upcoming new Volex products. Any teases you can leave us with for the next show, maybe?
The ink is dry.
Oh,
the contracts have been signed in order to launch our next product on equity realized volatility. I won't mention yet what the asset is. There are at least one or two other ones in the pipeline for beyond that, but we hope to have an announcement very, very shortly, since all the legal work is out of the way, for what the next vol contract will be.
Well, that's fantastic news. I know a lot of our listeners have been chomping at the bit to dive into these products ever since we first started talking about them. But for whatever reason, they're not currency guys, or they don't want to really dive into that product. A lot of them, I know, are really interested in having some sort of realized product on an equity index. So it'll be very exciting to see what you guys actually do come out with. I know I'm pretty interested. I have no idea, listeners. This is all going to be a surprise to me as well. So we'll keep that as yet another tease for an upcoming program. And that is going to do it for this episode of Volatility Views. Of course, I want to thank all of you out there for downloading and streaming and subscribing to the program and making it such a success. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments, and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.